Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business developments, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. India's GDP numbers have slowed to 7.1% in the first quarter of the current financial year, the weakest in 5 quarters. Now, the numbers are causing some concern given that the previous quarter saw a growth rate of 7.9% and the general expectation was that the trend would continue. Now, while overall growth numbers could pick up in subsequent quarters, there is some now worry on continued weakness in private spending and investment. So that leads to the larger question, is this quarter a blip or will the second quarter be stronger, as it often is, or is there cause for worry in India's economy? To discuss this, I'm joined by Sujan, Hajra, Chief Economist at Anand, Rathi, and Madan, Sabnavis, Chief Economist at Care Ratings. Madan, let me begin with your first question, which I guess most people would ask. Is the trajectory still holding and which way is that pointing now?
No, I think the trajectory is upward direction and getting a number of around 7.5, 7.6 in terms of gross value added for the year doesn't seem to be something which will be out of the ordinary. But I think the important part from this GDP numbers which we have gotten is that nothing much has really changed significantly. And whatever trends we have in the past continue to persist.
Give us an example.
No, for example, capital formation has been coming down, so capital formation comes down even now. So if we're looking in terms of overall whether there's been a revival in terms of consumer spending, not really. Is the government really spending as much as it's saying it's spending? The answer is not really. So I think it's more of a kind of a status quo. So even though the growth number has been lower than what it was in the last 4 quarters, I'm not too worried about that because these are all statistical kind of things happening. And if you look at the breakup of GDP, lots of sectors still show they're doing well. Maybe 9% is lower than 10%.
Construction seems to have gone down sharply.
I think that's the point where which was alluding to, because if we're talking of the government saying that they're spending a lot on roads, it obviously means that nothing much has taken off. And in fact, the RBI in the annual report has actually mentioned somewhere that the pace of government spending has not been according to what was planned. So therefore, I think.
So is it not what it was, what was planned, or is it not high? What is it?
It's not going the way in which I have a feeling they're saying that it's not according to what the government is saying. So the government is of course saying we're spending.
But it is high relative to, let's say, last year and the year before.
Relative to last year, because I think after the budget we were all thinking that the big bang investment is going to come from the government in roads and railways. So probably we'll have to wait for some more time. And since the second quarter is again the monsoon time where typically there won't be too much of activity, I think the third and fourth quarters will be where we'll see more buoyancy.
Right. So, Sujan, how are you reading it? I mean, are you seeing some anomalies, statistical or otherwise, and do you see the trajectory still holding?
Yeah, obviously there are certain anomalies. For example, if you look at the IIP data or core sector data, with respect to all 3 components, electricity, mining and manufacturing, they are not moving in tandem. Manufacturing in terms of GDP is doing much better than IIP. The other 2, electricity and mining is doing, if you see the higher frequency data, you get a better confidence. But what I think, what actually the difference between the expectation and the outcome, it has happened in terms of construction on the one hand, and if you look at fixed capital formation on the other hand, I think these 2 are related. In the sense, if you look at in the fixed capital formation by the households, almost 50% of that or more than that actually comes from housing. Similarly, if you look at in construction, housing has a very large contribution there. My sense is that it's not really the manufacturing slowdown or infrastructure slowdown. It's actually the slowdown in the housing sector which is moving the needle both ways.
Right. So let's pick up on agricultural as well. So agriculture has been slow, 1.6% last year, but expected to be over 5% this year. So is that all we are betting on now?
No, absolutely. I think the good monsoon, I think when we talk of something, I would say the third party which is there, which is the monsoon, we are relying a lot on the monsoon to bring about a better harvest which will lead to rural spending.
And I know you've been putting out quite a few reports on monsoons, but you're still deficient.
But, no, I don't think it's that. The deficiency is more in terms of being excess has come down to normal. So I don't think the crop is going to be affected, but I think we may be overstating the impact of this on terms of rural spending. Because yes, back of the envelope calculation, if you just look at the various kharif crops, and assume that the prices move up by a certain extent, maybe to the extent of MSP. So what we found was that the additional spending power as such, or the additional income for the farming community, wouldn't be more than around 15 to 20,000 crores. Well, it is a good amount. It's definitely a positive compared to the negative which we had.
But that's a good figure to go with. You're saying a good monsoon means about 15 to 20,000 crores of additional income in the hands of farmers.
Yeah, because we should also remember that when
is it farmers or rural India?
We're talking of farmers. Farmers, which will be maybe 50% of your rural spending comes from farmers. The rest will be coming from ancillary activities. So this 20,000 crores I think could be a positive factor, but I don't think it can drive the economy.
Right.
So the way we look at it is that things will be positive, but it's going to be a kind of a gradual pickup, and therefore we at CARE are still looking at a growth rate of 7.8% for this year,
okay,
which appears to be largely in conjunction with what even the RBI is looking at.
Right. So, anything that in your calculations is likely to change this, Sujan? And more importantly, what's your outlook here on?
No, my growth projection is anything between 7.8 to 7.9.
Okay.
So ballpark is the same level. I think rural consumption story, the monsoon is only a part of it, and it's the cyclical part of it. If you look at the structural part of it, there are two structural parts. One, obviously, there has been a change in stance of the government towards rural development. If you are looking at the same government 2 years back, it was all about industry, make in India, improving conditions for doing business. But more recently, there is a greater focus on rural development, which should be positive on rural consumption. Second, and perhaps the most neglected but the biggest play on the rural consumption is the impact of inclusion. At the end of the day, you have opened almost 30 crore Jan Dhan Yojana accounts. And you are pumping money there to the benefit programs and everything, and you are giving a leverage there. I think that, as Madan said, the impact might not be visible immediately, but this is a longer term positive for rural consumption.
Right. So, Madan, policy challenges, considerations to ensure that this does not go off track. Even the 7.8% or 9%.
To my mind, I don't think there's anything much which the government can actually do to make sure, except that if it adheres to its targets in the budget about what it's going to spend, which looks likely that will be at 1.4 lakh crores, which was projected capital expenditure this year, will probably be met. But I think the problem in India is one of demand. So I think when we are talking of make in India or anything on the agriculture front, I think these are all policies which are in the right direction. We are sending the right signals to investors, both domestic as well as international. But I don't think on its own they will be able to transform the economy in any significant way. So for example, we have GST. It obviously is not going to come in this year, it will come in probably next year. But I really don't see any kind of radical transformation in the way in which the economy works, except from the administrative part. For corporates, it's going to be obviously much easier and simpler. It's fairly seamless. Similarly, I think when we...
So you're saying no GDP growth kicker?
The GDP growth, I think I'm totally against that. I don't see how it will really work, except that if there's unaccounted money which gets accounted for right now. But even today I read in the papers saying that the SMEs are a bit worried that if you come forward and show yourself, you don't know what will be the implications in terms of repercussions about not revealing your income in the past. But I don't think that's going to transform our GDP, but definitely it will make it a more efficient place to work in. Similarly, even if we keep talking of land reforms, but to my mind, these are all peripheral issues. And they're very deep-rooted. You can't really find an easy solution. Right. And even if I have a land reform bill coming in, I don't think people are going to start investing just now just because the reforms are there. Just like we saw earlier, the stall projects were cleared by the government, but very few of them have actually started off. So I think it's a demand problem which has to be addressed, and it can be addressed only over a period of time.
Right. So going forward, I mean, what could go wrong, and what should we be careful about? Again, from a policy perspective.
See, I think still the biggest problem for India remains the financial system. Particularly the banking system remains a major problem. The interest rate structure, the cost of fund, that's the biggest problem. One needs to address that. The NPA problem, the restructured asset problem. Those are
so that's holding back potential or prospective capital investment.
Absolutely, okay. That's the biggest drag. Because if your investment is not picking up, obviously there is a reason for funding, there is a reason for cost of fund. So these are things which can be solved and which will yield faster results. As Madan said, there are a lot of structural things like land reforms. I'm slightly more positive on the GST than Madan, simply because I think the cost of compliance for the corporates goes down significantly. Second, the generation of black money under GST is the scope is significantly lower.
Right.
So even if the economy doesn't grow technically, just because the better reporting of income, that can actually take up the GDP growth. So my sense is that if you look at FY18, FY19, 50 to 100 bips increase in growth from here is pretty much likely.
Okay, so Madan, I mean, the downsides or the challenges, what can go wrong?
See, right now I don't think there's anything.
What should we be doing to ensure that nothing goes wrong?
No, I don't. I would say there's nothing much we can do to make things move in a faster direction, at a faster rate. Because I think it's going back to what I said.
You agree about the bank capitalization?
See, bank capitalization is definitely a theoretical issue as of now. I call it theoretical, and like Sujan was saying that it is a thing which can go wrong. Because according to me, when there is no demand for funds, Right now, it's not a problem.
Okay.
Bank capitalization, especially public sector banks, is a major issue. Resolution of NPAs is a major issue. And I think conditions are fairly fortuitous today that there's not much demand for funds. So I don't think these problems are going to come in the way in a big manner. At the margin, of course, if there is a risky project coming in, the banks will definitely not be willing to take an exposure given the NPA issue which they have. But otherwise, I would tend to think that we are on the right path, but nothing really exciting which is going to happen. And I don't see any major downside right now. Because I think the monsoon has been the only factor, something which we didn't know what was going to happen. But now that it seems to
be... So if you're saying
right,
that private investment and private consumption, right? So private investment is a challenge for the reasons we've just discussed.
Private investment will take over once private consumption increases.
And
so I think private consumption is something which has to increase. And then I have better capacity utilization, then I have more investment coming in. And that's when I see the economy actually accelerating.
Right.
So right now when you're looking at private consumption, the monsoon will contribute the good harvest will contribute to private consumption.
But only to the extent that you just pointed out.
Pay commission will also contribute to a certain extent, because even that 1 lakh crores, maybe around 30,000-40,000 crores will actually be spent. So all these will push the economy in the right direction, because there's of course a pent-up demand from all households. The last 2 years inflation has been quite very high. So definitely they will.
But
be
these also look like blips, don't they? I mean, if you look at it in the context of a $1.2 trillion economy, I mean, just 30,000-40,000 crores going up in a year.
It's a small amount. That's why I'm saying there's not going to be any kind of a major acceleration in growth. It will be a kind of a crawling in the upward direction.
Okay. Sujan, if you were to look at now in the context of both the capital markets as well as the economy, are things looking stable to you in the next quarter or so?
See, from the capital market perspective,
because capital markets are looking strong. I mean, we're seeing 52-week highs, unprecedented flows.
Yeah. See, the fact of the matter is that if you look at the broad-based level, the sales are growing somewhere close to 9%, ex-financial, ex-oil, and the bottom line is growing somewhere close to 15%. Nothing is spectacular. But in this results in what we realized, the number of disappointments were lower than the number of positive surprises.
Okay.
So the earnings downgrade cycle obviously is coming to an end, and there is a sense that your margin expansion will come into, whether it will actually happen, but there is an.
But India Inc. is on a stronger footing than it was.
Absolutely.
Or,
I think the biggest problem which is there ultimately comes down to inflation, because most of us, despite the inflation being around 6%, are becoming slightly complacent that inflation will come down. If it actually doesn't come down, that will be a major negative surprise.
Right. Unfortunately, we've run out of time. We need to go in for a break. On the other side, we talk about the markets touching 52-week highs and what's driving it, and should we be concerned? Stay with us. Welcome back. India's stock markets have been powering along mightily in recent weeks. The month of August saw both the BSE Sensex and the NSE Nifty recording their 6th straight month of gains and hitting 52-week highs. The Sensex touching 28,452 on Wednesday this week. Now, India's equities have risen 24% since February this year in the wake of strong liquidity, both global and domestic, as well as hopes of good rains back home. The question now is, how are the markets doing? Are they stretched given that the economy itself is not growing faster and broader concerns on capital investment and spending remain? And if so, what should we be concerned about, and what should small investors be looking out for? To discuss this, I'm joined by Andrew Holland, Chief Executive Officer of Ambit Investment Advisors, and Ajay Bagga, Chairman of OPC Asset Solutions. Gentlemen, thank you both for joining me. Ajay, let me begin with you. So, what's happening in the markets? Why this sudden exuberance?
No, I think it's been building up right since the budget, and as you mentioned, there's a lot of liquidity. So global liquidity coming in. Our estimate is about $200 billion of central bank note printing is happening every month, and some of that is finding its way into emerging markets. India remains a very attractive destination, both given the economic growth and the potential of India. So I think this continues for some time. There are very good catalysts on a domestic sense. Globally, there are some worries, especially the Fed rate hike, but we don't foresee that having a very big impact on India.
So very quickly, for the benefit of our viewers, why is this 200 billion additional printing happening?
It's more a convergent effort by the Bank of Japan, Bank of England, the European Central Bank, all the QE that is going on, quantitative easing, to help to reflate their economies and keep the economies afloat.
Okay.
So
yeah,
that's what's happening.
That's really the background. Okay, Andrew, what's your take? So why are we seeing such highs in the markets, and what's specifically driving it in your mind?
So I think there's no taking away that it is a liquidity-driven global rally, and what you've been seeing over the past few months is investors trying to search out whether it's yield. So we saw a lot of flows into the bond markets in India in the recent past as well. So chasing yield and also chasing growth, because there's no growth around the world either. So obviously India stands out on two counts there in terms of growth, and obviously the bond yields in India are quite attractive compared to anywhere else if you have a stable currency. So that's why we have been attracting more flows. And interestingly, on the equity side, most of the flows has been through exchange traded funds. And of course, these funds will naturally just buy the index companies. And that's why the index, the large cap index, has moved up so rapidly in the past 2 months or so.
Ajay, are companies performing as well? I mean, tell us about that. I mean, are we seeing consistency there?
See, overall economic growth is still muted, though it's a 7% plus print. Second, corporate earnings are still catching up. They're coming off an earnings recession, and now we are catching up. What markets are discounting in is a strong second half this year. And frankly, what is looking very evident is that the government is really coming into its own. The kind of reform pace that it has started, the infrastructure reform on the arbitration side, there's every day some or the other news flow. Finally, I think
so that's you're saying keeping the base steady or the strong.
It is giving a lot of expectation to the market that things are going to move. And now with the pay commission having been credited on Tuesday, there's a lot of liquidity coming into the market.
Right. So let me put the question slightly differently to Andrew. So Andrew, to what, in your estimation, to what extent is policy driving this sort of strong behavior or strength in the market?
No, it is. I mean, for foreign investors, looking at India, as Ajay mentioned, there's the policy reforms, is obviously given a lot of comfort that the growth of India over a longer period can continue. But that doesn't make you want to kind of pay, 20 times 1 year forward. I mean, valuations are stretched, even if you take a good second half, that the monsoons have been fine, and that this 7th pay commission, everyone goes out rushing to spend money. Earnings aren't going to catch up that quickly, so we're looking at maybe 10 to 15% earnings growth. So I think the market has discounted all of that. Now, whilst I'm fine with the Indian market, I think the problems are going to be global, because liquidity-driven markets, that bubble will burst at some point, and once it does, it's not usually a good event that makes that liquidity burst, and that would be outflows from India. So I think the stock market's got ahead of itself, helped by liquidity. I don't think we'd be standing here today looking at the market at these levels, just on the fundamentals alone for India.
And we've seen, Ajay, a lot of strength in domestic mutual funds, and we talked about that in a previous Policy Watch episode as well, that we're seeing record inflows into domestic mutual funds. So the sort of many ducks seem to be lining up.
Yeah, absolutely. The NPS money, the PF money, the LIC money, which obviously comes in every year, gives a big, LIC puts in 60,000 crores plus into the Indian equity markets every year out of its premium collections. And then you have mutual funds, SIPs, which are doing very strongly, nearly 3,000 crores a month coming in on the mutual fund SIP. So that's very retail money, 40,000 crores of that money, which is coming in month on month. That's giving a good sound base to the markets.
Right. So let me then look forward now. If all of this is looking so good, but yet there are concerns on the economy, in as much as it's not growing as fast as we should, some of the spikes may be driven the spending spikes may be driven by pay commission and factors such as that. Should we be concerned?
I'm not as concerned now. I'll tell you why. There is enough liquidity in the market. Government has done a fairly good job. And now, as I'm saying, the experience seems to be showing through. Now they are able to handle situations much better. Look at the kind of protection given to steel, this talk of tires. Now you're getting to that stage. Second is the economic revival is on. It's still very slow, but like this infrastructure 40,000 crores announcement, that itself boosted sentiment very strongly. So second is the economic revival. The third big thing going for India, that it stays as one area which is growing in a slow world. So we will continue to attract investments. And overall, very well-run companies. We are coming out of a down cycle. This is going to be a multi-year bull market, to my mind. And we're just at the cusp of it, just the start of it. There is no excess, there's no euphoria, there's a lot of skepticism, as you mentioned. And globally, there's a lot of skepticism, but you can't put your finger that this asset is very excessive today.
Right. Andrew, what's your sense? We talked about the global liquidity flows. Ajay talked about the $200 extra billion that are being printed. Is that something that we should be concerned about? If it could it go away and very quickly?
Yes, it can, and we saw that exactly what happened in January and February. I mean, don't forget, the Nifty at that time was down at 6,800. So money flows can come away very quickly, and as most of the money flows has been through exchange traded funds, those will be the first ones where you'll see exits by foreign investors. So here's where we are. I mean, we're living in negative rates all around the world. One of the interesting things that the Federal Reserve Chairwoman said, Yellen, was that she was concerned that yields are so low globally, which makes you think that obviously there's something wrong with the monetary policy if she's saying that. And you're hearing more and more noises from European banks talking about negative rates or low yields really hurting them. So maybe there's a shift now to push interest rates up in the US, even though the economy, whilst it's looking strong, there's still some very weak data out there underlying the economy, which people are ignoring. So maybe we're going to see a rate hike sooner than we thought to try and push yields higher. But that runs a risk of obviously any growth that we're seeing faltering very quickly, and that would again bring us back to January, February. Is what can the central banks do to get the economy going without any fiscal measures, policy measures to boost spending, and that's where I think we are. They've seen quite a number of countries now like Japan, South Korea talking about doing fiscal spending, and that's really what you need to get the economy kick-started now, because monetary policy is not working to the extent that people were hoping. So it's kind of one of those funny, we're in that kind of funny situation where people are saying low rates are great, and high, if the Fed goes, higher again, that's okay too. There's something wrong with that picture. So I suspect that what you're going to see is the problem's going to play out in the bond market first, and then currencies, and then finally equity markets. Now, whether that's tomorrow or next week or in 2 months' time, it's difficult to gauge liquidity-driven markets, but we know it's coming. We just don't know the timing.
Ajay, what's your sense in terms of absorption? I mean, there have been some concerns from amongst mutual funds, for instance, saying that they're not finding enough small cap stocks or mid cap stocks to buy into. Are we, in that sense? I mean, is there enough supply where there is so much demand?
Yes, I think there's enough supply. Again, as the size, it's also a question of mutual funds having balance, that you have to shut down a fund. You can't keep taking money into small cap, mid cap funds and run a 10,000 crore fund and then complain about the market. I think that balance has to be there. A few funds like BlackRock stopped taking new inflows into its micro cap fund.
So you're saying it doesn't reflect anything larger or with the market, or in terms of a problem with the market. It's only a problem with the fund.
The balance has to be there. Of course, there is an impact cost in the market, and our mid caps are really micro caps globally, because our large caps would be mid caps except giving the BSE Sensex 30 out. So that is a known factor. It's not an unknown factor for funds, and they have to manage that.
Right. And you're saying, despite all of this, I mean, you stand by what you said earlier, which is that you're still feeling bullish about things, and you feel a strong policy-driven impact in the markets.
I think we are just starting, and this government is going to really work very hard going into the national elections of 2019. UP might have a blip, but I'm positive on UP as well, of hung assembly, but a poll outcome being positive. Apart from that, I think this goes on quite well.
So fundamentals are strong, or sound, right? A good note to end on. Ajay, thank you so much. Thank you, Andrew. That's all we have time for in this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.